Look at this chart. PayPal is down massively from its all-time highs, down 10% just today after the earnings report. Half of Wall Street is screaming that it's a dying company and a massive value trap, while the other half say it's the ultimate generational buy. Who is right? Today we are taking the emotion completely out of it and letting the raw data decide. Now, I know I've been quiet on the channel for the last 3 months. I stopped uploading, but I didn't stop working. I was in the lab finalizing something that has taken me 8 years to build. It is a complete automated valuation system designed to pull a company's fundamentals, run them through a 18 points quality scorecard and instantly calculate its true fair value. No guessing, just math. Today, I'm going back to our MoneyJourney roots. We are putting PayPal stock into this brand new system to see what is actually worth under the hood. If you are serious about finding real value in the stock market and want to follow along with this new data-driven era of the channel, make sure to hit that subscribe button right now. Let's jump into the spreadsheet and run the numbers. This is the MoneyJourney stock analyzer. It's not public yet, but I'm going to launch it next week. However, to say thank you to everyone who waited during my break, I am giving away 3 free copies this week. To enter, just leave a comment below, tell me which stock you want me to analyze next. Let's start inserting the PayPal ticker here. It gives you all the numbers really fast. Bear in mind it's really automated, but don't bear in mind the first fair value and quality score. So because this template is done for you to do your assumptions and come with a fair value and the quality score based on what you think or believe PayPal is worth. So let's start with the fundamentals. Fundamentals of PayPal are incredible. Just trading at a P of 8 for a P of 7.8. Which means earnings yield around 12%, price to free cash flow of around 13.6% free cash flow yield. At first sight it looks incredible cheap. In terms of margins, gross margin of 46, operating margin around 20, net margin of 15%, growing revenues around 6%. When you look to the balance sheet, $9.3 billion in cash and long-term debt of 9.4. So basically their net cash is zero, so they could pay all their debt with the cash they have in their balance sheet. So that's a very good sign. Returns on equity 25%, return on invested capital 21%, 5-year average of almost 19%, which is a very good return. In terms paying a dividend of 0.6% right now, but they are doing a lot of buybacks at average around 5% per year, which means a shareholder yield around 6%. Performance year to date down 22%. Just today it's down 10%, massive. When you look to the graphic information, it is a company, it's not a dying company. Revenues growing very steadily year after year. Profits averaging out, so revenue growth is slowing down to around 4%. It usually grows. In the previous 5 years it was growing above 15% per year, but right now growth is slowing down. In terms of net income per share, free cash flow per share is trending, is going higher, which is a good sign, but it's mostly not because earnings or free cash flow is increasing, but because PayPal is doing plenty of buybacks, which increase earnings per share. In terms of margins, they are maintaining them, which is a good sign. Gross margins between 46% and 50%. Net income margin, free cash flow margins between 15 to 20%, which are really good margins actually. And we are not seeing a sign that margins are going down. Maybe gross margins slightly going down, but there are always this fear that where PayPal is doing business, there are plenty of competition, Stripe, Block, Apple Pay, so that's the bear case for PayPal, and it is a good one. Plenty of buybacks, trend is going down, and return on invested capital going up, which are the trends that we like to see in a company. Looking at these visuals, PayPal is a great company in terms of fundamentals, but is the company really good? Let's look at our quality scorecard. This is not automated, it's for you to do it. So I'll go side by side. In terms of revenue growth, it's a check mark. They've been growing around 6% revenues. In terms of futures prospect, they are expected to grow around 6% earnings per share, mostly not due by incremental growth in their earnings, but mostly due to buybacks. So it's a yes. In terms of the quality of their revenues, I'll not say that good or bad. It's consumer based, so it's a medium, it's not recurring. It depends on the consumer, but it's not cyclical as well. So it depends on the economy overall. In terms of process development, research and development, I'll say it's average. They are developing new product. They have Venmo, that's a great success. Braintree, they are divesting into other business, which is very good, but it's not exceptionally good. In terms of margin, really great margins. Gross margins 47%, profit margin at average 17%. Have they been maintaining profit margin? That's the major doubt. For now, still close to their maximum. Of course, it's slightly down. Gross margin from 50% to 46%. Net and free cash flow margins always vary year by year, but between 15 and 20%, which are very good. And the bear case for PayPal is that competition will eat their margin, that their margin will increase in the next few years. You'll see. For now, they are still having very healthy margins. So I'll say yes, but if you say no, that margins are declining, I will not disagree with you, because it's not a downward trend already, but it could be. But for me, I'll say that they are maintained. In terms of margins versus competition, I'll say it's average. They don't have better margins or worst. Actually, they might have still better margins, but we don't know. In terms of pricing power, that's what I disagree. I don't believe they have a pricing power right now. So there are plenty of competition that they could not make their product or the cost of their product increase, because they have no pricing power. That's just my opinion. In terms of debt, balance sheet, it's very healthy. Rates of return, yes, return on invested capital on equity is very high. So in terms of management, it depends on you. I would say it's a good culture and reputation management that is very competent, but in terms of new products, it's a very hard sector. So plenty of competition, it's very hard. That's what I don't like in PayPal. It's the sector they are in, because there are a lot of competition, and I don't like to invest in companies that have plenty of competition. In terms of moat, I would say it's between narrow, sustainable. I'll say a narrow moat, because in financials, I don't believe their moats are very, very high. It's a network effect. Enduring, maybe not. Deteriorating, maybe deteriorating. In my opinion, their moat, with the competition they are facing, I don't believe their moat will withstand. But that's just my opinion. It will depend on you. It's your assumption. That's why this template is very helpful for an investor like you, because you do your own assumption. It automatically selects what is the average from past years, but it has to be you to put your own assumption. So they have been growing free cash flow per share around 11%, very good growth, and they are returning plenty of capital to the shareholders, which I love, in terms of dividends, and doing plenty of buybacks. So overall quality score 57, which is average from the S&P 500. Fundamental wise, PayPal is great, but in terms of quality of the company, I do not believe they have the best moat, pricing power, and overall this is a very hard sector to be in. So is it cheap? Yes. It is a good business? Yes. PE expansion? Yes. So you could have all of that, you could make a very good return, but I could not say that PayPal will be here in 10 years, or at least will be growing in the next 10 years. So that's what I don't like. So in this income statement, I'll just make a resume where we have revenue, net income, free cash flow, stock-based compensation, which is a real expense, shares outstanding, return on invested capital. So, but PayPal is cheap, In terms of fundamentals, great. Quality, for me, my opinion, is not the best business out there. But is it really cheap as everyone is saying? Let's do our analysis. So in terms of stock-based compensation, I'd say they will maintain what they have or even getting it slower, maybe less, 4% decrease in the next few years, because they are getting mature as the time passes. So it is a United States company. What is the business risk? I'll not say it's low. They are very safe in terms of balance sheet, but their business, there are some risks to be medium for me. What will be my assumptions for my base case? Growth they expect to grow around revenues around 3%. For my base case, I think it's okay to assume 3% growth. They are a very mature company right now. Free cash flow margins, in the past, they have free cash flow margins of 18%, 14, 21, 16, 16, but free cash flow margins are always higher than the net income margins. So, and with some margin compression in the future, resulting by competition, I believe 15% will be better use case. So in terms of PE, that's where it gets hard to choose. It's not a great company, not the best mode, so I'll go with even 15 PE. They are trading at the 10, so I might assume a 12 because I don't like 15. It's the average. Maybe you could argue it's very low, but in terms of financials, their modes are not very high. There are a lot of uncertainty for their future. So I do not want to assume higher P, so I want to have some margin of safety. So with these assumptions, I came with an intrinsic value of around $64.5 per share. I believe I'm conservative, because it's not the best business out there. But with this, with PayPal trading at $45 per share, we are expect to have a return of around 15 to 16% at this price if PayPal still holds in the next few years. It is a good buy. In terms of valuation, yes, it's very compelling at this price, but not when it was at $100, $150, or as a lot of think believe that PayPal is worth like $100. Not in my opinion, because the quality of their business is not the best. Then could look at our dashboard. We can see all these metrics: price, fair value, 30% margin of safety, quality scores in terms of the company, 57.2 out of 100. Not the best, not the worst company. In terms of fundamentals, really great, but their business, even though they are performing very well, not growing much, but their fundamentals are good, it's not the biggest moat out there, and they are facing plenty of competition. With this, we expect to have a return around 15 to 16% based on our assumption, and for me it's a buy. Maybe I will add it to my portfolio. If it was a better company, I'll get interested, but since it's not a company that I could be for sure in the next few years they will be out there, I prefer to be on the sidelines. I prefer to buy companies that have wider moats and they don't face a lot of competition like PayPal faces with Stripe, Block, Apple Pay. But fundamentals great. All the trends are going in the right way for now. So when we zoom out and look at the final MoneyJourney scorecard, the picture becomes clear. The stock price might look like a disaster, but the underlying machine, the free cash flow generation and the balance sheet tell a different story. Valuation is everything. You don't buy a stock just because the line went down. You buy it because the math proves there is a margin of safety. PayPal clearly has hurdles with its growth and margins, but at this multiple, the downside is heavily priced in. Now, I want to hear from you. After seeing the raw data from the system today, do you think PayPal has the moat to turn this ship around, or is the competition simply too strong? Let me know your thesis down in the comments. And if you got value out of this deep dive, hit that like button, subscribe to MoneyJourney channel, and I'll see you in the next analysis.